ETFs, exchange-traded funds, which everybody talks about, and I'm guessing people might understand about 80% of what goes on, and maybe the other 20% a little cloudy. So we're going to clear it up. You're going to clear it up. I mean, this is an enormous product. This is an enormous asset out there, more than $1 trillion worth, right?
Right. Well over $1 trillion, covering almost every kind of security and strategy you can imagine. But people are often confused because ETF does stand for Exchange Traded Fund, and then you have mutual funds. And so what's really the difference between the two? So,
I mean, mutual funds, we know, still far more popular than ETFs. Does it have to do with cost?
There are some very fundamental differences in the plumbing of these two kinds of things, and I really think it's useful for people to understand them because they come with different costs and benefits, and you really want to understand that when you get into an investment strategy. A lot of people think that, mutual funds are more expensive than ETFs because ETFs are usually pegged to an index, and mutual funds have to pay an active manager, but that's not really where the cost difference is coming from the most part. It's in the underlying structure of how these things operate. So when you are invested in a mutual fund, you buy a share, you send money directly to the mutual fund itself, it gets the money, it goes and buys some stock with it. When you want to get out, you say, hey, I want to get out, so we got to meet that redemption. They sell some stock, they take the cash, and they give it to you. That's all well and good, but the fact is that requires a pretty substantial internal infrastructure to handle all of that processing and accounting.
So then where is a broker involved, where is a broker not involved?
So with the mutual fund, if you're talking about a no-load mutual fund, you should be paying very minimal, if any, brokerage fees because you're dealing directly with the fund. The shares are not traded on an exchange. I mean, people often make that mistake, but the mutual fund shares are not traded on an exchange. ETF funds, their shares do trade on an exchange, and therefore, when someone wants to get in or out, they've got a buyer or a seller on the other side, and the fund itself, the ETF, is not involved in that transaction.
Now, how do you deal with this, how should I say, just reconciliation, right? When you buy, when you sell, securities are not the same prices. They move around a lot.
Okay, so here's the thing that's very interesting, because if you look at a closed-end fund, there's usually a big disparity, or very significant disparity anyway, between the price of the fund and the net value of the securities inside of the fund. All right, now that's not true of a mutual fund because we just talked about how the redemptions occur. They're always in balance. But if you have a fixed portfolio and it trades, the supply and demand for the portfolio as a whole will move over time, and closed-end funds get out of whack. The price of a closed-end fund gets out of whack with the total value of the assets inside of the fund.
Which is a big point to make because then there's also an arbitrage kind of profit happening as well, right?
Right. So when you've got closed-end funds, a lot of hedge funds make money on that arbitrage. But in ETFs, that's completely not allowed.
It's not even a factor.
It can't be. It won't work with an ETF. You can't have an ETF that doesn't reflect the actual price of the basket of securities inside of the ETF. So the big mystery is, if they don't do the redemptions themselves like a regular open-end mutual fund, how do they keep the share price in balance with the total value of the securities inside of the basket?
So how does it happen?
It happens through the magic of something called an authorized participant, an AP. So these are basically licensed arbitrageurs. It's a very interesting idea. They sit and they look, and what happens if, let's say that the price of the basket is getting too high. There's more demand than there is supply for the ETF. What the authorized participants do is they say, aha, perfect opportunity. They go and they buy the basket of securities, exactly the basket of securities that the ETF currently holds. That's a known fact. It's usually based off an index. But whether it is or it isn't, you can know what those are. So they buy that exact basket, and then they take the basket of shares and they go over to the ETF and says, oh, Mr. ETF, would you please take my basket of securities and in exchange for that basket of securities, issue me some new ETF shares? The ETF says, yes, be very happy to do that. Takes the basket of securities, issues the shares, then the AP goes and sells those shares in the market, adding supply to the market, bringing the cost back into line of the ETF with its underlying basket of securities.
So basically, the ETFs have a little help, the mutual funds don't.
Exactly. They have, that's it. They have outside licensed arbitrageurs, effectively, who are constantly getting rid of the price disparities between the basket of the securities and the ETFs themselves.
All right, ETFs cheaper to operate, but a little bit more expensive to buy and sell.
That's right, because typically when you do an ETF, you're buying and selling through a regular stockbroker, and the stockbroker is taking his regular commission on the trade. So in a way, that's how you pay for the fact that the APs are out there in the market constantly readjusting the price. For mutual fund investors, they're paying for the mutual fund itself to have that mechanism inside.